A very special guest now joining in to talk about that. We have Jeff Brown. He's president of the FGE Group right here on our channel exclusively. Thank you so much for taking time out, Mr. Brown, and joining in. To begin with, despite the blows to the supply that we've seen in the year 2019 in the forms of attacks in the GCC region, crude prices have stubbornly refused to budge from that range of $55 to $65 a barrel. So what do you think are the factors that are at play for the market?
Yeah, I mean, there's really three legs you have to focus on with the crude market. You correctly pointed out there were attacks, there was a lot of turmoil early in the year, but the market is very much focusing on the fact that demand is pretty weak. You know, we're growing less than a million barrels a day right now, and at the same time supply, if you look at non-OPEC supply, it's growing by about 2 million barrels a day. So you have that million barrel a day gap that's really putting pressure on the market. The market has been helped out by Trump in the sense that he's taken out with Iran and Venezuela about 2.5 million barrels a day. So when you put all this math together, quite oddly, there's a lot of things happening in the market, but it ends up being that the market's reasonably balanced and sort of stays around this $60 range. Now, of course, there's a whole lot of things that could send us in one direction or another over the rest as we move out into 2020.
So while a trade war or maybe a global slowdown are more cyclical factors that could hamper demand, what about the more structural shifts like the EV one? How do you see demand being influenced by a mix of all of these factors?
Yeah, what we've seen near term is the real impact on demand has been more through the trade war, as you say, and also manufacturing has slowed down. Services are doing fine, but manufacture has really slowed down, and that's weighed on oil and particularly diesel, which you see a lot in India actually as well. Going forward, EVs will have an impact, but when you look at the real impact on the market, that's more of a late 2020s, 2030s issue. So really what we're seeing in the near term is it's just a good old-fashioned sort of economic slowdown, especially in the manufacturing sector, that's weighing on oil. And that's really what's sort of keeping us at these, not bad levels, but sort of at the $60 type range.
Okay, so to put it in numbers, what is the oil demand at present versus what it was, say, 3, 4, 5 years ago? And how do you see it shaping up over the next couple of years?
Yeah, good. This year, for 2019, we have oil demand growing about 600,000 or 700,000 barrels a day. If you went back, a few years ago, we were up, well over 1 million barrels a day, 1.5 million barrels a day. So it has definitely slowed down substantially. When we look out into 2020, we're looking at about 900,000 million barrels a day there. So we see a bit of a rebound based on some petrochemicals and other things, but it's not a huge rebound. So that's, the demand side looks, frankly, not that great going forward over the next few years.
And to what extent will the drop in demand be contributed by the EV shift? Or do you think that oil will still play a role in the energy mix since passenger transport accounts for about 40% of demand, not all of it?
Oil has a long future ahead. The problem is the growth will slow down. So we're looking at once we get out into the early 2030s, transport fuels will likely flatten out and hit a ceiling. And overall oil demand growth will also flatten out probably in the late 2030s. So we'll definitely move into a situation where it's very, very flat, no real growth. That doesn't mean oil is going away. We'll still be needing to consume well over 100 million barrels a day of oil. But it does have big implications for certain sectors. For example, for refining. You won't necessarily need more refineries. A lot of the downstream implications are very large for that. But we still will need to be looking for oil, drilling for oil, finding this stuff.
So based on the kind of forecast that you have for demand and supply in the oil market for this year and the next, what sort of a glut deficit or situation do you think we could be staring at?
Yeah, when we think about the near term, what our balances show, we go through and we add up supply and demand and we look at how things are trending. As we go through the end of this year, it still looks pretty tight to us as we move through the end of 2019 and into early 2020. What will happen here is it gets a little complicated because remember you have OPEC meeting in December. So they will get together and we think they'll say, okay, everything looks pretty good. Let's.
Well, the market's currently at about 11,901 as we speak. But we were in discussion talking about crude oil prices with Jeff Brown, the president of the FGE Group. Apologies for that interruption. And I'm just going to get back to you. Are the days of seeing crude oil prices at levels of about $100 a barrel firmly behind us now? What kind of a forecast would you have for crude prices for 2020? Where do you think we could see it average in the long haul?
Well, I mean, forever is a long time, obviously, but for the foreseeable future, we have a lot of supply coming into the market. You know, if you look around this year, 2020, the U.S. is going to grow close to 1 million barrels a day. We also have big supply coming out of Norway, big supply coming out of Brazil, big supply coming out of, we'll have some out of the Gulf of Mexico. There's just a lot of supply, coming into the market. So, it's over 2 million barrels a day increase out of those areas that I just mentioned. So this is the problem over the next several years, a lot of supply on the horizon.
And how dominant do you think these new oil suppliers like Norway, Guyana, along with US, Canada could be? Will they take the OPEC's power away?
Yeah, obviously the U.S. story has been going for a while. There's some new kids on the block, like you said. Guyana is new, but ramping up very quickly. Basically, the story is right now, non-OPEC keeps increasing for the next several years, and OPEC has to cut. It's that simple. Now, their cuts, Mr. Trump has helped out OPEC in the sense that they've taken out Iran and Venezuela, so those OPEC players are cutting whether they like it or not. So that has oddly helped roughly counteract this increase in supply. So it all works pretty well. The math works pretty well in that sense. But it doesn't leave any room for OPEC to increase. So if Iraq wants to increase, Iraq talks about increasing supply. Kuwait, UAE, others talk about increasing their production capacity. This puts pressure on them. They can't use it, right? They are in a position where they have to maintain or cut back. That is essentially their position.
We're just a couple of days away from the next OPEC meet on 5th, 6th December. What will be on the agenda, especially since Riyadh has a very strong incentive for crude to be higher, also of course of the Aramco IPO?
I think all the market signals that we see, inventories are okay. Price is a little bit over 60. If you look at the market structure, all the signals that we would look at is that the market's okay. And I think OPEC, we know a lot of them. They will look at it and say, we're doing a decent job. Let's keep this rolling over. I don't think the price isn't maybe as high as they would like it. I think that they'd like things more up in the 70s. But 60 is generally, in the 60s is okay. Frankly, we also think that this is probably a reasonable balanced price for them right now. So I think generally what you'll be hearing out of this is things are okay, let's hold the course. I would be really surprised if there's any big change that comes out of this OPEC meeting.
Fair enough. Now, I know you don't talk equities, but can't help but just, ask you about the current environment that we're in, what you're making of the timing of the Saudi Aramco IPO in light of crude oil prices. How do you expect responses to be at a time when Mohammed bin Salman himself, via the IPO, wants to reduce the kingdom's dependence on crude?
Well, in terms of the valuations, I think a lot of the discussion around it, they wanted $2 trillion. Most people when we were looking at it, was something lower than that, somewhere in the we were looking at 1.3 to 1.6 type range. It looks like now they're moving in that direction in terms of valuations. Obviously this is, it's not just driven by economics, of course. A lot of this is a statement in the direction that Saudi Arabia and Aramco want to move, and they've we had heard multiple times within Saudi Arabia that some camps wanted to move forward, some camps did not want to move forward. Clearly, the camps that did not want to move forward got sidelined, right? So, and this will happen. It's obviously going to happen. It's moving forward. And it looks like the market's starting to price it around the levels that we thought it would get priced.
We appreciate you taking the time out, giving us an overall view as to your forecast for crude oil prices, as well as how you see the demand shaping up, and of course the Saudi Aramco IPO.